Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's Director of ETF Research, Nina Mishra, to talk about the hot ARK ETFs. What should you do? Should you stay in it? Should you buy into them? Should you just ignore them? What's happening with the ARK Innovator ETFs, the hottest ETFs of ETF land, let's just call it that, since they launched, and led by Cathie Wood, who is now, I would say, kind of an icon in the investing world these days. She is, you can just say Cathie, and she's on a first name basis now, up there with, Warren and some of these other first name type investors. But ARK funds had a bit of a problem in 2021, but that could be a buying opportunity maybe here. So Nina, I brought you on because you are our ETF expert, and we've talked about the ARK ETFs in the past, but I think the last time we really focused on them was after 2020, when she had that huge year for her flagship ARK Innovation Fund, the ARKK. That's one of our oldest funds. It was launched in 2014, and in 2020, as all those big growthy tech pandemic names were hot, it returned, what was it, like 150%, I think it was, in 2020. But this year, in 2021, sorry, because we're now in 2022, but in 2021, it was down about 24%. So what's going on at ARK these days, Nina?
Hi, Tracy. Yes, you are right. ARK was the biggest ETF story of 2020. So 3 of ARK ETFs were among the top 10 performers in 2020. And their flagship fund, as you mentioned, that returned more than 150%. And their Genomics Revolution ETF, ARKG, was the best performing ARK ETF of 2020. And that had a gain of over 200%. Their next generation internet ETF, ARKW, that also did very well. So the firm, ARK ETF, they had assets less than $3.5 billion at the beginning of 2020. And at the end of the year, their assets had grown to over $41 billion. So that was an asset growth of more than 1,000%. That was just incredible. And they became a top 10 issuer in 2020. Now they are no longer in top 10 because, as you mentioned, some of those high growth, high flying stocks have come down this year, and most of her ETFs are down for the year. The Genomics ETF, which had a return of more than 200% in 2020, was down more than 35% last year, and the flagship fund, as you mentioned, was down more than 20%. And that is despite excellent performance by Tesla, which is the top holding in the flagship fund. So obviously, Cathie had become a superstar due to her performance of her ETFs in 2020. And at one point, at the beginning of 2021, she was gathering ARK ETFs. Were gathering more than $1 billion every week. It was totally insane. And now it's very difficult to say whether it is time to buy or, just avoid these ETFs, because these are high-flying stocks. If rates go up, and some of these have, they will start earning and making money, earning net profits, maybe 10 years, 15 years from now. So when rates go up, those stocks, which have profit projections far out in the future, they suffer, and that is something that we saw last year too. So it is very difficult to say, but people have compared the performance of ARK with Genesis 20 and some of other high-flying fund managers. In fact, we will talk a little bit more about Genesis 20 because you remember that very well. But I also saw another stat by Mev Faber of Cambria Investments, Cambria ETFs. So he pointed out that in 2010, 5 US stock fund managers were nominated for Fund Manager of the Decade by Morningstar. And all those underperformed over the next decade. And the one which was the best performer over the last decade, that was Bruce Berkowitz Fair Home Fund. That was the worst performer in the next decade. So, I mean, these things happen. You're one of the hottest fund managers for a year or 2 years or 3 years, and then maybe your performance goes downhill. So far this year, we have seen, despite poor performance, many of ARK fans, they have stuck by Cathie. I mean, we have seen that inflows slowed down, and then we saw that some investors were withdrawing their money from ARK funds, but there was no rush for exits. People believe in her fans believe in her long-term strategy, and that is what Cathie says, that these are not short-term strategies, these are long-term strategies. And recently, in fact, she said that her strategy would deliver 40% compounded annual rate of return over the next 10 years. And there was some controversy regarding that statement, and then they clarified that the statement applies to disruptive innovation strategies broadly, doesn't refer to any particular product or fund. So we will see what lies ahead for ARK ETFs in this year.
Yeah. In her defense, the ARKK, which is the original fund in 2014, although ARK Genomic Revolution is also 2014. I guess they were funded at the same time, now that I look. But those two oldest ones do have the best track record. And ARK Innovation is up 374% since that inception versus the S&P 500 up about 137%. And ARKG is up 204% since inception. So she does have the track record on her oldest funds of beating, and this quite, a stellar record, especially with ARK Innovation. But as you said, a lot of trends tend to change. Like there are managers who just get the hot hand in the right things at the right time, and then the trend changes on them, and that's not anything of their fault. It's just the trend changes. But I did want to mention that on ARK Innovation, you mentioned that Tesla is their largest holding, and Tesla was up about 50% last year, but even still at 10% of ARK Innovation, it could not overcome what happened to some of their other holdings. So a few of the top 5 that's in that fund, Teladoc is number 2 on size in that fund, and it was down 54% last year. Roku is number 3, it was down 31%. Coinbase is number 4, it was down 26%. And then Unity Software, one of the better performers, that was down only 6.8%. And then she had Zoom right after that, down 45%. So I'm kind of surprised it actually did as well as it did, maybe because it does have that big position in Tesla, which was still up 50%. But, it is heavily weighted in a lot of these very innovative growth names that just, mostly got hammered last year. But that's what you're buying. That's what It's called ARK Innovation. So you are buying these. Yeah.
So looking at the long-term performance that you mentioned, so obviously her funds did very well in 2020, but if we compare the performance of ARKK, the flagship fund, with the NASDAQ 100 ETF QQQ or QQQM, I saw that these two funds, these two ETFs, had very similar performance till the beginning of 2020. It was only because of her, excellent, mind-blowing performance of ARKK in 2020 that it has managed to beat the QQQ over the long term since its inception. And similarly with the Genomics Fund too. The Genomics Fund had a performance which was very similar to the Spider Biotech ETF, XBI, and like IBB, XBI is equal weighted, so it has a lot of exposure to those innovative small cap and mid cap biotech companies. So ARKG and XBI had very similar performance till the beginning of 2020, and then ARKG had that insane 200% surge in 2020. So that is why it is significantly ahead of XBI now since inception. But again, talking about Cathie's strategies, I'm a big admirer. I may not necessarily agree with her that these strategies are going to deliver a 40% annualized return over the next 5 years or whatever. But she remains very firm in her beliefs. She has strong conviction in her strategies, and her research is, the ARK research is actually very good. If you go to the website and, read the research, it is very, very good. And we all remember when she made that call for Tesla going to $4,000, everyone was like, what? Because Tesla was trading near $200, $300 at that time. But, now on split adjusted basis, Tesla is far ahead of that price target. So I would never ever bet against Cathie. I may not buy her funds, but there are people who are, brutal in their criticism. And there's an ETF now which shorts ARK. It is, the ticker symbol is SARK, SARK. That has done very well because since inception, it's a very new fund because ARK is down, so that fund has done well. But I would never bet against Cathie. That I'm very sure about.
So does the SARK, does that just short ARK Innovation, ARKK? Is that what it's short?
Yeah. Yes.
Okay. Wow, that's clever. That makes sense. Okay, so this is interesting. If you're telling me that her fund, the ARKK, basically had the similar to the QQQs, that makes sense, and that ARKG is similar to XPI, why wouldn't I just buy the QQQs or the XPI with the cheaper expense ratio?
Yes. So if you want to invest in all those tech high flyers, I would prefer to invest in, high quality technology companies. So QQQ with an expense ratio of 20 basis points, or its cheaper version QQQM with an expense ratio of just 15 basis points makes a lot of sense for long-term investors. But obviously you don't get a lot of exposure to smaller companies that Cathie has bet on. You will have a lot of exposure to the likes of Apple, Microsoft, Amazon, Google, and Tesla, and also Facebook and NVIDIA, but not to smaller companies like Teladoc or Intelia or CRISPR Therapeutics, which Cathie bets on. But, if you believe in technology, then QQQ or QQQM are the way to go.
Yeah, that makes sense. Okay, so the biotech, sorry, it's not XPI, it's XBI. I'm like, I'm losing my mind. And that also has the smaller yield too. So, okay, so these are just like the more general, not actively managed, obviously, index type funds. But
yeah, these are both passive index tracking funds. That is why they are very, very cheap also compared to our ETFs. And there's one thing I would like to mention, that while inflows have slowed down, this is actually a very good situation for Cathie, because we remember that when her funds were, our ETFs were getting more than $1 billion every week, everyone was like concerned that how will she invest? She will have a lot of money to invest, and so either she would start buying those large cap, mega cap stocks, or otherwise she will have a very large position in some of those smaller cap and mid cap stocks. And having that kind of concentrated exposure, that leads to a risk. And if the market plunges and investors head for exits, then and that could lead to a lot of volatility in these type of stock, mid cap and small cap stocks. So I think with inflows slowing down, Cathie has more flexibility, more leeway on where to invest. So this situation is actually good for her as far as the inflows are concerned. I'm not sure about the performance, obviously.
Yeah, no, I agree. It was going to get a little just too difficult for her to invest that much money that was flowing in there. And as we've talked outside of this podcast in the past about what happened to the Janus 20 fund. Now, that was a mutual fund, not an ETF, but they actually had to close it because too much money was coming in and they couldn't invest all that money in the late 1990s when that one got hot. But I do think it's interesting to look at Janus 20 in terms of what might still be coming for the ARK ETFs, because Janus 20 was one of the hottest funds of the 1990s, and I saw that it was the 7th largest stock fund at the end of 1999 with 37 billion in assets. Didn't you say ARK was at 41 billion in assets in 2020? So
Right.
It's similar surge, not surprising because people chase performance. But it fell at an annualized rate of 24% during the dot-com bust because it owned a bunch of those names, especially it owned both America Online and Time Warner, which ended up merging, and then those plunged down, in addition to the plunging of all the other, even, the big safety stocks like Cisco that it owned, because Janus 20 only owned 20 stocks. So that's how they, were able to outperform. But they returned 73% in 1998. That's when we all said, Janus 20, we have to buy it. And we all jumped in. And then it closed to investors in 99, also had great performance in 99. And then it was down for several years. And then everybody fled it. And I think by the end of 2003, I saw a stat that it only had 9 billion in assets because people chase performance, right? And they wanted to get out of there. So I'm not saying that ARK, this is the trajectory for ARK. We don't know yet, but they were able to turn it around by changing their holdings. So by 2003, its two largest holdings, it still included Microsoft, which had fallen quite a bit by that point, but Exxon was among its largest holdings, as well as United Healthcare, which was not on anybody's radar in 1999. Neither was Exxon at that point. So, and then it had sold out of all of its AOL holdings. But Cathie has a different strategy of, this innovation and growth strategy. So it'll be interesting to see, she's staying in it. Obviously, it's only faltered for just this last year in 2021, and nobody knows what it's going to do going forward. But Janus 20 basically had to change its strategy to adjust to the market conditions. Exxon at that time would have been a value stock, as well as United Healthcare. Both of those would have been value stocks by 2003 there. So
Right. So many people compare ARK to Genesis 20, and you gave a good summary of what happened then. And the advantage which Genesis 20 manager had that was that Genesis 20 fund was a mutual fund, so they could close the fund to new cash, new investors. Cathie doesn't have that flexibility. ETFs cannot close to new money, so there's less flexibility on investing, and or when your fund grows too big, then how to invest. So that problem has been solved by some outflows or slowing down inflows. And also many people compare our Genesis 20 situation and the internet bubble burst to the current situation, because last year the S&P 500 was up about 27%, posted 70 record highs during 2021, and more than doubled since the start of 2018. So this was the highest 3-year return since 97 to 99. That is when Genesis 20 was very hot, and that was just before the bursting of the internet bubble. So I don't think we are in that situations, because valuations are not insane, and especially if you look at the performance of the major indexes last year, particularly the S&P 500 and the QQQs, those performances were driven mainly by these mega cap tech stocks, the likes of Microsoft, Google, Nvidia, which are making a lot of money. Their earnings, because of their earnings power, their valuations don't look insane. So I don't think that we are in the situation like just before the bursting of the internet bubble. What do you think?
Yeah, I don't think so either. I do think it's not as crazy with speculation as what we saw in the late 1990s, and last year's cool off of the growth stocks should help moderate people's expectations quite a bit going forward. But I don't know. We'll see. I mean, could it be over for the growth stocks, but the rest of the market, as we saw last year with the S&P, busting out to those new highs, could we continue to see the overall indexes stay pretty hot, but some of these growth stocks not? That could happen. So I don't know. I'm waiting to see what kind of rebound we get in some of these growth names, if anything, to start here in 2022. But I did want to talk a little bit about one of the superstar fund managers who did manage to hold on to his track record for a longer time period than even Genesis 20 was able to do, or, as maybe some kind of guidance to see what possibly Cathie might be able to do in the future, because Peter Lynch at Fidelity, he's one of the older investors from the 1970s. He ran Fidelity's Magellan mutual fund from 1977 to 1990, when he decided to retire at age 46, by the way. He threw in the towel, but he did get out before that bull market ended, well before. But $1,000 invested when he started, according to Wikipedia, was $28,000 when he left. It was a 29% a year annualized return for the fund while he was managing it, and it outperformed in all but 2 years versus the S&P 500. And I couldn't find the actual yearly returns going all the way back. The furthest back I found was 1984. From 1984 through 1990, his fund only underperformed just 2 years in there. So I'm assuming those are the years that they're talking about. And the worst was in 1987, when the Magellan was up only 1%, but the S&P 500 was up 5.3%. And that was the year of the big market sell-off crash that happened. But S&P 500 still ended up that year, as did Magellan, barely. But still impressive performance over a longer period of time with that 29% annualized. But he had the luck of, managing throughout most of the bull market, and then the bull just kept on galloping even after he retired. kept going,
Right.
as we just discussed, another about 10 years after he left. So we don't know yet what's happening with this current bull market and what Cathie will do over the next several years.
So it's interesting that we talk about the Magellan Fund, and it was a very hot stock fund then, and it has managed to continue its performance. And that is the reason why Fidelity decided to launch an ETF clone of that fund, which has a similar strategy. And we know that these mutual fund managers, many of them are either converting their mutual funds into ETFs because of greater tax efficiency, greater transparency, and the ease of trading, or they are launching ETF clones of the popular mutual funds. So Fidelity launched a clone of their Magellan fund in February last year. It is called the Fidelity Magellan ETF. The ticker symbol is FMAG, FMAG. And this is actively managed like the mutual fund. And interestingly, it has gathered only 55 million in assets so far. So people just don't care about, Fidelity Magellan's any longer. Whereas when Cathie launched the space ETF, there was so much excitement about her space fund. And in fact, all the space related companies like Virgin Galactic and all, they started soaring when the news of this ARK space exploration ETF came out. And that ETF launched in March last year, and it gathered more than 475 million in assets over the year. So this was one of the most successful ETF launches of 2021, and Cathie's latest ETF is actually passively managed an index ETF. It is called the ARK Transparency ETF. The ticker symbol is CTRU, and it seems investors are not interested in any of her passive ETFs, because this ETF has gathered less than 20 million in assets since its launch in December last year. And there were not a lot of excitement around its filing or launch. So people just care about things that have been hot, or themes like disruptive innovation or internet or space. So they don't care about the ARK Transparency ETF at all.
Wow, interesting. So how much assets under management do you have to maintain in order to keep the ETF running? Like if that one only has 20 million and Fidelity's only has 40 million, do they keep running it at those levels? Do they run it for a couple of years and then throw in the towel? What's the level that you have to be at?
So if an ETF fails to gather more than 50 million in assets over over 1 or 2 years of its launch, then it becomes difficult to justify continuing the fund. Now, for bigger providers like Fidelity or even for ARK, they can run a loss-making fund too, because if they have so many assets under their bigger funds, so they may not necessarily liquidate that ETF. But if it's a smaller ETF provider and they have just like 1 or 2 or 3 ETFs, and though that ETF has less than 50 million in assets and it's been around for 2 years or more, then the chances of liquidation, those go up.
Yeah, that's interesting. So people like to chase the names for sure. And I feel like the current younger generation of investors has no idea what Fidelity Magellan even is. They're learning about it for the first time on this podcast. I don't know. And it has been a long time since it was really in the spotlight, over 20 years for sure. So even though the original fund still is going to this day.
Yeah, I'm sure Magellan is not popular on Reddit boards because Cathie
No.
is obviously very, very popular on among meme stock traders, and she gets a lot of mention on Reddit as well. And she's very popular in some other countries too. I read that she has a lot of fans in South Korea and Europe too. So obviously, younger investors believe in those kind of strategies. She believes in crypto too. She has a lot of exposure to crypto related companies, and millennial investors, younger investors, they are bigger believer in digital currencies and that ecosystem than the older investors. So obviously her strategies are more popular with younger investors. They don't care about the likes of Magellan.
So can you buy the ARKs if you're outside the US?
So yeah, there are some strategies available to investors who are not in the US. I'm not really familiar how they invest, but they are able to invest. That's what I read. There's some strategies available to investors in Europe and investors in South Korea also. How they invest in ARK ETF. Obviously, they cannot invest directly, but something similar. Indirect strategies are available in those countries.
All right. Well, it's going to be an interesting year to see what happens with the ARK ETFs. We're all going to be watching it, obviously. And, it had the big sell-off last year in most of the funds. And we'll see what happens here in 2022 and what the investor reaction is going to be, whether or not they stick with her for another year or start jumping ship. It did take a while for the Janus investors to start jumping ship. It wasn't until, into 2001 or so that they started yanking the money out there. So we'll see.
Similarly with ARK funds too, investors are not rushing for exits because younger investors, probably they believe in the strategies, probably they can stick around for another 4 or 5 years if they're a big believer in her strategies. So we will see how her funds perform and how the broader market performs this year, because we have had 3 years of double-digit returns. So it doesn't look likely that the market will continue to go up at that pace. But I don't think that we are. The market is going to plunge this year. We are not close to a bear market or a big correction.
All right, let me recap a lot of the tickers that we talked about. So on the ARK side, there's the ARK Flagship Innovation Fund, ARKK. The genomics is ARKG. Then we did talk about the passively one that no one's in, what's called the Transparency ETF, CTRU.
Yes.
Ticker with that one. Then if you just want to trade with less expense ratios, you can get similar strategies in the QQQs and the QQQM. Is the QQQM, that's the same as the QQQ, isn't it?
Right. It's a cheaper version of QQQ.
Okay. And it has less expense ratio?
Yeah, so QQQ has an expense ratio of 20 basis points, and QQQM has an expense ratio of 15 basis points. So QQQ is one of the most popular ETFs in the world. So it has a lot of liquidity. It trades in great volumes. If you're a trader, you use QQQ. If you're a long-term investor, then you use QQQM.
Okay, good. This is good because I always get confused with the two, and I'm sure I'm not alone. Okay, so those two, and then you can buy the biotech one, which is XBI. And then we talked about Fidelity's Magellan ETF that's launched. If you're interested, go check it out at FMAG is the ticker on that one. And as always, I'm going to be bringing you all the hot topics and things going on in the stock market every week here on the Market Edge. And we're just getting started here in 2022. Should be an interesting year with the Fed making some moves, and who knows what else is going to happen. But it's always good to be in a new year and get some new ideas. So be sure to subscribe to get all of our podcasts. You can get them on Zacks.com. We have a podcast tab up at the top. You can get Nina's podcast as well. She always has great guests on her podcast talking about everything that's going on in the world of ETFs. So be sure to check out her podcast over on our podcast page. And you can get all of our podcasts on Apple. We're on Spotify. We're on Amazon Music. But be sure to get us somewhere. And I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.